All right, today we're pulling back the curtain on Wall Street, but we're not talking about a bunch of confusing stock tips. Nope. We're digging into the actual playbook the pros use to build and size up billion-dollar companies, the kind of knowledge that usually stays locked away in the most exclusive firms on Earth.
Yeah, just let that sink in for a second. Our source material for this explainer says it best. This isn't just about making some money, it's a whole way of thinking that has created insane amounts of wealth. And, it's kept exclusive for a reason. But we're going to change that right now.
So, the billion-dollar question is, what's actually in this playbook? What's the secret sauce that lets an elite banker look at any company in any industry and just see things that the rest of us miss? Well, let's break it down.
Okay, it all starts right here with a super powerful framework for looking at a company's whole competitive world. It's called Porter's 5 Forces. And trust me, this isn't some boring theory from a textbook. It's the mental model they use to figure out where any business stands by looking at 5 key things: competition, new players, customer power, supplier power, and substitute products.
The first force is competition. But the smartest companies, they don't just compete. They completely change the game. I mean, take Apple. You think they're just selling you a phone? No way. They're selling you the AirPods and the MacBook and the iPad, and all of a sudden, switching to Samsung means you have to leave this entire universe you've bought into. That's not an accident. That's a strategy.
Next up, how easy is it for a new kid on the block to come in and challenge the king? For a company like Apple, the walls are sky high. You'd need billions in cash, a global supply chain, a massive distribution network just to get in the game. If you can't build a competitor in a college dorm room, that business is way, way more valuable.
And this part is just brilliant. It's all about the customer's power. By yourself, your decision to buy one iPhone? It doesn't really move the needle for Apple. But what about when you're the only green bubble in your friends group chat? That little bit of social pressure is a massive force that Apple uses to keep you right where you are.
Finally, who's really in charge when it comes to the supply chain? Well, when Apple places an order, it's for hundreds of millions of parts. Their suppliers are totally dependent on them. This gives Apple this incredible power to dictate prices and terms, a power that smaller companies just don't have. So understanding the battlefield, that's step 1. Step 2 is building a fortress around your business. Investors call this a moat. It's basically how you create a lasting and kind of unfair advantage.
A powerful brand is so much more than a cool logo. Apple makes you feel like you're part of the future. Patagonia isn't just selling you a jacket, they're selling you a belief in protecting the planet. And Red Bull, they don't really market an energy drink. They market a whole lifestyle of insane adventure.
Now this is just pure genius. The story goes that Jeff Bezos literally sketched this out on a napkin. Cheaper prices bring in more customers. More customers mean more sellers want to join the platform, which gives you a huge selection. A better selection leads to a better experience, which, guess what, brings in even more customers and lets them lower prices again. It's a loop that just keeps spinning faster and faster on its own.
And this might just be the most powerful advantage of them all, the network effect. Think about it. The very first telephone was basically a useless brick, right? Who could you call? But as soon as there was a second one, the first one suddenly had value. Every single phone added after that made the entire network grow in value, like exponentially. It's the exact reason it's so hard to start a new Facebook or Instagram today. All your friends are already there.
Okay, so we know how the pros analyze a business. But what about the bankers themselves? What do they actually do all day? Let's go ahead and bust one of the biggest myths out there.
This quote from the source material just shatters the whole paradigm. The idea that you need some $250,000 Ivy League degree to make it big in finance is, well, it's just wrong. So if it's not about the degree, what is it about?
The reality of the job is not what most people imagine. Building those super complicated financial models and fancy PowerPoint slides, that's maybe 20% of the work. The other 80%, it's pure sales and relationships. It all boils down to knowing who writes the checks and being the person they pick up the phone for. And to win at that relationships game, you have to understand this next piece of the playbook. In a world full of generalists, the ultimate advantage is being a hyper-focused specialist. Seriously, trying to be everything to everyone is just a guaranteed way to fail.
I mean, just listen to how different these two pitches sound. The generalist says, we raise 10 to 100 million for any industry. It sounds kind of vague, right? A little unconvincing. But the specialist says, we secure 20 to 50 million in construction financing for multifamily developers in the Southwest.
Now, which one sounds more credible to you?
And that's exactly why the specialist wins, every single time. When you're that specific, you build instant credibility. You know their challenges, you speak their language, and this is the most important part. You already know the right investors who are actively looking for that exact type of deal. You're not just making cold calls, you're a matchmaker.
All right, for our final section, we're going to do something crazy. We're going to condense years of business school into the next minute and completely demystify the art of valuing a company. And believe me, it is so much simpler than you think.
Forget all the complicated formulas you've seen. At its heart, valuation is incredibly simple. The whole game, every complex model, every analysis, it all boils down to one single thing: making a smart, defensible guess about how much cash a business is going to generate in the future. That's it.
Now, to make that guess, you really only need to understand 3 documents. The first is the income statement. Think of it like a company's report card. It shows revenue minus costs over a period of time, and what's left is the profit. But profit isn't the full story.
Now, this is so critical. Profit on paper is not the same as cash in the bank. The cash flow statement tracks the actual real money moving in and out of the company's account. This tells you if the business is actually generating cash, which at the end of the day is what really matters.
And finally, there's the balance sheet. This isn't a story over time. It's a single snapshot. On one side, you have everything the company owns, its assets. On the other, everything it owes, its liabilities. And the difference between those two is the equity. That's what the shareholders truly own.
So how do you put it all together to get a number? Well, while business schools love to teach the super complex discounted cash flow model, the truth is most bankers just use a practical shortcut. It's called comps. They simply look at what similar public companies are worth and use that as a benchmark to value the business in front of them.
So, we've covered the frameworks, the moats, the myths, and the mechanics. The secrets of the elite banking playbook? Well, they're not so secret anymore. The only question left is the one on your screen. Now that you have the playbook, what will you build?